All right, good afternoon and welcome everybody. This is Ryan Bouchey. I hope everyone's doing well and we appreciate you joining us for our webinar today, Introduction to Responsible Investing. Typically, over the last year or so, we've been doing quarterly webinars as it relates more to the stock market and your portfolios. We want to try and include in between these quarterly webinars more of retirement planning, financial planning, different topics that we can speak to you about. And this is the first one that came to mind. If you do have any suggestions or things you may be interested in, please give any one of us a call or email and let us know some suggestions to introduce new topics to these webinars. But like I said, we'll probably try to do these in the middle of the quarters, in between the updates on the stock market and the economy. So I'm going to kick us into today's discussion. We have David Rath, who's our portfolio strategist, that will get into the meat of the responsible investing topics. Today, we're going to talk a little bit about, what is responsible investing, what are the benefits, what are the risks, because as with anything in investing, there are risks involved. And, if you are interested, how we can work with you to create maybe a portion of your portfolio that touches upon some of these subjects, or do an overhaul. But something that we can certainly help you with, or even just having a discussion as to the pros and cons. So the many forms of responsible investing, you may hear it come up a lot in the news or online, and it has different names, different ways to call it. We'll probably go through today mostly calling it ESG, the environmental, social, governance, as it touches upon those topics, and we'll get into that a little bit. You may hear as socially responsible, impact investing, or sustainable investing. Essentially, these are all the same things. You'll hear it again called many different names, but we'll discuss it mainly as ESG moving forward. So what is it? So what does the E, S, and G stand for? E is for environmental. You can see the different topics that you may want to have companies that target these areas, or companies that aren't really working in these areas. So energy consumption, pollution, climate change, waste production, natural resource preservation, animal welfare. Maybe in certain cases you are responsible, thinking about global issues and global weather issues, and maybe you don't want to invest in a energy or gas producer like an ExxonMobil, but instead want to get into companies that are focused on solar energy, or a company like maybe Tesla that's focused on energy, different kinds of sustainable energy. When it comes to social issues, the S, have human rights issues, maybe child and forced labor, community engagement, health and safety concerns, stakeholder relations, employee relations. One of probably the original examples here is getting away from a company like a Philip Morris with regard to health and safety of consumers, and looking to something. I know recently in the news, Dick's has come up where they're removing some of the firearms from their sales. Maybe something like Beyond Meat recently. That again, more for if you believe in more of a vegetarian, non-meat diet. And governance issues, you have quality of management, board independence, conflicts of interest, executive compensation, transparency and disclosure, and shareholder rights. Again, maybe you look at something where just recently in the news you had a descendant from Walt Disney complain about their CEO's pay, and so maybe you're interested in executive compensation, and you think Bob Iger is paid too much, so you want to get away from Disney. But a company like Intuit, which has about a 40% makeup of their board, is in a diversified board, and so that's important to you. Probably one of the highest in corporate America. So those are different issues that may come up on the governance side of ESG investing. The history goes back to about the 1960s or 70s. I guess what the big we're in a capitalist society. These companies and especially public companies are trying to do everything for their shareholders. Essentially, the board and the executive committee are working for shareholders, and a lot of times you may see instances where short-term profits are really what the key is for some of the decisions they make. I think going back to the 60s and 70s, there was sort of a movement against this and wanting to get into more, again, align their investments with what they felt. And so you really saw it with the start of elimination of sin stocks. You had the alcohol, tobacco, firearms, casinos. And from that, we'll show over the last 20 years or so, just some substantial growth into an over $20 trillion industry today. And again, here's just going back to 1995, probably around $1 trillion in funds throughout the U.S. for this responsible and ESG investing, to now you have over 12 trillion in other portfolios and ways to build upon this responsible investing. So with the brief history, let's get into a little bit more of the meat of the discussion, sort of how it's aligned today, what options are out there, and we're going to have David Rath go through some of the, again, benefits, some of the risks, and how we can go ahead and help you if this is something you are interested in potentially implementing within your own portfolio.
Thank you, Ryan, and thank you everybody for joining this webinar. It is something that we've heard a lot about in the news, and also some people have brought it to our attention regarding exactly how to implement it in their investment portfolio. So today we really hope to give you an idea of what is available out there and then what next steps you can take. So Ryan did a good job of covering the history of ESG, or responsible investing, and where I want to go is where are we today and where are we headed. So really the next step is with the socially responsible and impact investing. So as Ryan mentioned, it really started out with the elimination of certain types of stocks. So the alcohol, tobacco, firearms, but really we're seeing it evolve into much more of an industry where these companies are working to, or the ESG strategies are working with companies in order to improve the outcomes from corporate decisions. So that's really where the socially responsible and impact investing comes in. As you can see, there are some examples, which is, we'll get into them in a little bit, but dealing with gender diversity, Catholic values, women empowerment, and we'll get into some more right now. So the first one I want to discuss is just a general broad-based ESG ETF. And this one is the iShares MSCI KLD 400 social ETF. It really rolls off the tongue. As you can see, the expense ratio is fairly inexpensive. The AUM, the assets under management, it's over $1 billion. So this is one of the more established ETFs in the ESG space. I did include a listing of the top 10 holdings, and we'll dive into that in a little bit regarding what exactly you're getting when you are investing in an ESG strategy. So as you can see, this is much more of a niche offering where it's focused on women's empowerment. In the prospectus, it says they're tracking an index of large and mid-cap U.S. equities that are selected and weighted to maximize exposure to firms that score highly on gender diversity. As you can see, the expense ratio at 76 basis points is higher than the broad-based investment strategy that we just covered, and the AUM is only just over $4 million. And again, that's one of the risks that we'll get into later with some of these strategies that really refine their focus to target a very specific type of strategy. Next up, we have two of my favorite ticker symbols, TAN and FAN, dealing with more of a climate-focused strategy where the solar ETF and then the global wind energy ETF, as you can see, their top 10 holdings are very, very specific with regards to that specific strategy. One thing I do want to point out is if you look at the weighting of the top 10 holdings were at 62.4% for the solar and 54.66% for the wind energy. So as you're deciding whether or not these make sense to you, you have to realize certain things like concentration risk. And if you're buying an ETF with the thought that you're getting a diversified exposure, you might have a majority of your money concentrated in just a handful of stocks. So this is not a comprehensive list of data providers. This is probably the more recognizable. You can see everybody from MSCI, who puts out a variety of indices, as well as Bloomberg, Morningstar. Calvert was one of the pioneers in this space. They were one of the first companies to offer products back in the 1980s. So anybody that has had exposure to ESG throughout the years, it's probable that they had one of the Calvert mutual funds. And when it comes to the data providers, they all have different opinions and different styles of scoring these companies. So I think this is a really important point to touch on, because what ESG means to, let's say, Bloomberg might be something completely different, or at least somewhat different from a Sustainalytics score. And so again, as it relates to you and your investments, if you are looking to just give yourself a general ESG makeover in the portfolio, you want to make sure that your values and what you are getting into is aligned with what that data provider is, what they have in mind for ESG. So some issues and risks associated with ESG investing in general. So as I mentioned, using a single score to assess an overall ESG level, it is a challenge, because you can look at a company, let's say Facebook. So Facebook, they might score highly on a climate change or a carbon emission score. Maybe they installed some solar panels at their headquarters, and they score very highly on that. But I'm sure everybody's aware of some of the data privacy issues that they've run into in the past couple of years. And so it's tough to balance out the different areas of ESG with assigning an overall score to a company. So, and that ties back into my the previous slide, where you're looking at how exactly is the data provider, how are they scoring them, and which sector of ESG are they weighting more heavily. Also, what does ESG mean to you specifically? So this is one of the harder things that I've ever had to approach from an investment portfolio standpoint, because you might have a different opinion than your next door neighbor on what exactly ESG means. So you might be much more of the type of person that wants to invest in companies that limit carbon emissions, but your neighbor might be more concerned with social or governance with relation to the investments. Also, just like anything else, Wall Street is going to see this as a profit opportunity. So we have been seeing a preponderance of funds being rolled out with catchy ticker symbols, with names that are looking to generate some assets under management, which in turn generates profits for the firms. And a sad fact is many of the funds fail to gain traction. So they can have really great ideas, a really strong management team, but for whatever reason, people just aren't getting on board with them, and they end up closing down the fund. So these are just some things to take into consideration when you are looking to invest your money somewhere. As an example to my last point, this is the Pacer Military Times Best Employers. VETS is the ticker symbol. I think everybody can agree that U.S. companies with veteran and military-friendly employment practices is something that's a good thing for society in general. Giving the vets jobs as they come back into the country. As you can see, it was founded a little over a year ago. It is more on the expensive side. 60 basis points is a little expensive, but in the last year, they've only gained $2.86 million in assets under management. So this could be a potential fund that closes its doors in the coming years, just because they aren't generating the amount of assets under management that they were hoping to get when they opened the fund. Now, this slide is titled "The Devil is in the Details." So I took two ETFs, took away the names, and looked at the top 10 holdings. If you were to guess, they look pretty similar. You might say these are just two broad-based funds, maybe not an ESG tilt to them. But the first one is the S&P 500 index fund. So as you can see, dominated by the likes of Microsoft, Apple, Amazon, etc. Now, the second fund is one that we went into before, which is that Women Empowerment Fund. So if you're looking at these two side by side, you can say they look very similar and a lot of the top 10 holdings are the same. So if you are investing with the idea of women empowerment in mind, you could be getting just a more expensive S&P 500 fund for all intents and purposes. Sure, they might exclude some companies, like there's no Berkshire Hathaway in the top 10. The Facebook is not in the top 10 of the women, but for all intents and purposes, the investment performance could be similar minus the extra fees. So again, this is something to be aware of if you are considering this. One thing that's brought up with relation to ESG investing is that the performance is something that was a drawback. And for years, I think that was the case, especially because of the way that they approached the investment style, which was just eliminating those sin stocks, as we talked about. I think that the future of it is still uncertain. And the Morningstar did a study here that shows out of their 56 Morningstar ESG indices, 41% of them, or 41 out of the 56, outperform their non-ESG equivalents. Now, I know what most people are thinking right now. Well, that's a pretty high percentage. Maybe ESG is the way of the future. I should just invest my money according to the ESG to gain outperformance. I would take a step back here and realize that this is still short-term performance. It is something that is more correlation rather than causation, I would say, especially if you look at where the outperformance has occurred. A majority of the outperformance was in the European and Asian markets, which we haven't seen as much growth as we've seen here in the United States. So it's really tough to determine whether or not this is something that's going to give outperformance in the future. But I think it's safe to say that at the very least, it might not subtract from performance as it did in the past. So I think that was really important to highlight, because that is something that is always brought up when somebody's talking about ESG investing. So the implementation of an ESG portfolio, MSCI identified 3 client objectives for the implementation. The first is you want to improve your investment results. As we talked about last slide, we're not sure if that's really going to be the case moving forward. It has occurred in certain areas, but there's not really enough data to work with right now to say that you will get better investment results if you were to invest in ESG. Personal values and positive impacts. I think that is the reason to invest in ESG, is aligning your investments with what you feel is important as a person. So when you're considering, I would hesitate to say that the improvement of the investment results is something that you would be able to specifically bank on, but you will be able to align your investment strategy with what matters to you. So as it relates to Bouchey Financial Group and the implementation that we can offer, we are working on some model portfolios. It's a great place to start. We expect to be rolling these out fairly shortly. They are just going to be the general ESG overlay in those funds. So we do have the opportunity to get thematic with the tilt. So let's say one of those ESGs, let's say the women empowerment or the military vets, that's something that really speaks to you. We can include that as a part of your ESG portfolio. But for the most part, our model portfolios are going to be just, here are companies that score high overall on the ESG scales. Again, it's the ability to match your values with your investment strategy. Here's just an example of a model portfolio. ETF.com looked at what are the least expensive, or what is the least expensive way to implement one of these ESG portfolios. So without any other considerations, obviously they look at creating a diversified portfolio, but they just look for the cheapest way to implement it. So as you can see, the blended expense ratio, 17 basis points, is not anything that's going to break the bank. So one of the benefits of the ETFs getting into the game, just like everything else, is they are driving down the cost. So you would be able to get a strategy that is labeled an ESG strategy, but it's not going to break the bank for you. I'd say the next steps, I put my contact info here. You can always email me directly, give me a call at the office. My information is there. I'd love to talk to you. I'd love to answer any questions that you may have. We can review the current portfolio that you have. Once those model portfolios are ready to roll, I would be able to discuss in detail with why we chose that, and maybe you want to make some changes and some improvements on the model that would tailor it specifically to your strategy. So feel free to shoot me an email, give me a call. I'd be happy to talk to you.